Ladies and gentlemen, good day and welcome to the Windlas Biotech Ltd. Q1 FY’25 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risk and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Today on call, we have Mr. Hitesh Windlas, Managing Director, Mrs. Komal Gupta, CEO and CFO. I now hand the conference over to Mr. Hitesh Windlas. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us today for our financial results for quarter ended 30th June 2024. We have uploaded the press release and investor presentation on our website as well as on the exchanges. I hope that everyone must have gotten an opportunity to go through it. Initially, I would like to discuss the outlook and way forward for Windlas Biotech, followed by financial highlights for Q1 FY’25 of the company, which will be shared by our CEO and CFO, Ms. Komal Gupta. While the Indian pharma market registered a YOY growth of 7% in Q1 of FY’25, with marginal volume growth of 0.4%, our company outpaced these figures, achieving a revenue growth rate of 21% in the same period. This growth is driven by strong performance in the CDMO vertical. The EPS improved to rupees 6.47 in Q1 FY’25 as compared to EPS of rupees 5.79 in Q1 FY’24, experiencing a growth of 12% YOY. Expansion of business development team, broadening of customer base, and launch of new products are yielding strong outcomes in the generic formulation CDMO vertical. Trade generics and institutional vertical is expected to continue its growth momentum for FY’25. We have expanded our sales force in core and adjacent territories for trade generics and have also improved penetration in several new institutional accounts. Government policies continue to accelerate medical coverage to vast number of economically backward Indians through schemes like Ayushman Bharat and Jan Aushadhi, and we are well positioned to serve these opportunities. We are very excited about being a partner of choice for our clients during the implementation of the new quality guideline Schedule M by the regulator. Our own trade generics brand leverage this manufacturing excellence and bring us ability to address the underserved large population of India. The same manufacturing excellence is our gateway to build a strong business in emerging markets. We are on track with respect to building additional capacities through several brownfield initiatives that shall enable us to deliver aggressively towards our growth plans. I will now request Ms. Komal Gupta, our CEO and CFO, to discuss the financial performance highlights. Over to you, Komal.
Thank you, Hitesh. Good morning, everyone. We are pleased to deliver 6 times in a row the highest ever quarter revenue, showcasing YOY growth across all business verticals. The company's revenue grew by 21% YOY to 175 crores in Q1 FY’25, wherein YOY EBITDA growth is 22% at rupees 21 crores and YOY PBT growth is 12.1% at 18 crores. Q1 FY’25 profitability margins have improved for existing business in comparison to Q1 FY’24, Q4 FY’24 as well as full financial year FY’24. As stated in prior updates, this quarter the additional operating costs and depreciation associated with our new business injectables have also kicked in without any revenue contribution in this quarter. Despite this, an almost 25% increase in minimum wages for all plants, the company has delivered robust overall EBITDA of 12% and PBT of 10.5%. We expect revenue from injectable facility to clock in starting mid Q3 FY'25 as production batches are being made which finish their required stability testing. Upon initiation of revenue from injectables, we expect positive impact on profitability margins. Q1 FY'25 is also the largest ever revenue quarter for generic formulation CDMO vertical. This vertical generated revenue of 135.9 crores with YOY growth rate of 23% in this quarter. Improving engagement momentum with customers through operational excellence and enhanced service levels has been a sustained effort in generic formulation CDMO vertical. This, combined with launch of new products and wallet share expansion, continues to be the focus. Our trade generics and institutional vertical generated revenue of 35.1 crores with YOY growth rate of 14%. We have expanded our distribution network and added new members to the sales team to cover additional territory within our core geographies. We have also added more institutions as well as more products to expand the outreach of this vertical. Our endeavor to provide accessible, affordable and authentic medication to rural masses is finding strong resonance with the marketplace, and we are gearing for a strong FY'25 for this vertical. Our exports vertical demonstrated revenue of 4.1 crores in Q1 FY'25 with YOY growth rate of 10%. We have entered into an agreement to acquire a basket of market authorizations in Europe to expand our product portfolio and geographic reach. We are excited about the vast growth opportunities and our strong momentum in all business verticals. That's all from our side. We can now begin the Q&A session. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Sudarshan Padmanabhan from JM Financial PMS. Please go ahead.
Yeah, thank you for taking my question. So my question is to understand a little bit more deeper on the employee cost. When I'm looking at the employee cost both year on year and Q on Q, the number seems to be quite sharply up. Partly, you did mention that there has been some hires and the main wage hike. One is as we move forward. I mean, the first quarter is usually a relatively lower quarter as far as volumes are concerned. And as we pick up the momentum, I mean, there will be an operating leverage. How do we see this cost getting, absorbed as the capacity comes in? Because, I mean, I would have probably expected the margins to be slightly higher, which was impacted because of the employee cost. The second is, on the depreciation side. I mean, typically the 3.5 crore run rate has gone to 6 crores. That is an increase of about 2.5 crores, whether you take it a year on year or a quarter on quarter basis. It looks like, too high for a plant which is 70 crores. So annualized, it comes to like a 10 crore impact for a 70 crore plant. So a little more color on this.
In personal expenses, there are several factors that have contributed to the growth, both versus Q1 as well as Q4. One, as I just mentioned, there has been an increase in minimum wages of about 25% in Uttarakhand. So that nobody could expect that, but that has now come and remains as the base going forward. Second, injectables related manpower cost is also part of this personal cost, and as against which revenue are yet to start. So as revenues start clocking in all the OPEX areas, against that obviously you get a positive inflow, and that is why we expect the margins to get better once injectables revenue start clocking in. Third, in personal cost, there is also ESOP 2023 scheme that we started last year. Last year there was in Q1 the scheme 2 impact was not there, which is there in Q1 FY'25. So in YOY that is also one of the factors. Other than that, of course, for higher production and annual increments that take place in first quarter. So all these factors have impacted our personnel cost, and still, so we are not saying that this stays like this. Once you have the revenues coming in, if you see YOY, we have still been able to manage or a 0.1% higher deliver EBITDA margin. So up to EBITDA, this is what we are saying, as against OPEX of injectable. Once that revenue starts coming in, this should get better. Then coming to the depreciation piece, depreciation, the company follows WDV, written down value method, which means that in the initial period, the depreciation is always higher in our case. So as you see, the rest of the gross block of the company being 260-270 crores, the overall depreciation amount annual is in the range of about 12 crores. So for injectables, the initial depreciation amounts anyway were expected for us to remain high, number one. Number two, bigger portion in our injectable state-of-the-art facility is of plant and machinery, and plant and machinery is a high depreciation rate factor. So about 18% I think is the depreciation rate that applies on bigger portion of 74-75 crores. So that is the explanation. The depreciation, but I would say that depreciation in that sense is a non-cash expenditure, but in profitability, this becomes the new norm. Initial period, and as we see a couple of years pass and the WDV on which calculation of depreciation happens keeps becoming lower, then depreciation should keep reducing.
And also there is no major, any extra capex or no major out of the norm capex that has been done. So whatever is depreciation is there is pertaining to more or less the factors that Komal explained.
Sure, sir. And sir, excluding the injectable plant, what would be the utilization, sir, in the CDMO?
The utilization should be around 65%.
Sure, ma'am. The next question before I join the queue is, when I'm looking at levers for margins, one is, as you mentioned, 65% is the utilization. So the existing plant itself, as the volume goes up or the utilization goes up, there is operating leverage. Second is, as we get the injectables and the volumes from the second quarter, I mean, you did mention that, the GX part of the business will improve, with the hiring and also the injectable coming in. So just wanted to understand, I mean, now that all the costs are in, there is no additional surprise there. As we move towards the FY'25 end and towards FY'26, with the mix and operating leverage, should we start, expecting a consistent improvement in margins? And if you can give some color of what are we looking at in terms of what can be the additional margins? Because I understand injectables come to higher margins, right, 18% or something. So from that perspective, would like to get a little bit more color.
Yeah. So, see, the existing business already has, we have in this quarter as well improved margins, and they are continuing as is. So 65%, as we have mentioned earlier, 65%, 65 to 70% is the highest peak capacity utilizations for us. So we are parallelly, as we had mentioned in the earlier call, also working on expansion of plant 2. And that is in full swing. We expect that to, by end of Q2 or beginning of Q3, that portion to be also available. So revenue growth wise, we should not face much of an issue. And that is just an extension, not a whole new facility. So in OPEX, we do not expect too much of increase, other than, of course, the basic manpower cost will be there, but all common head level costs stay the same. So looking at that, we expect even existing business to do better. Injectables, as we had mentioned earlier, good EBITDA margins should be in place once we have, once we are near peak capacity utilization levels.
Sure. Directionally, our margins should improve, right, over the next 1 to 2 years, given all this.
Yeah, they should get better as injectables revenue starts putting the overall company level revenue. Margins you should see better.
Sure. And one final question before I join back with you is, when I'm looking at the client addition between FY'23 and probably the last annual report, the last 2-3 years, the number of client addition has kind of doubled. And, we are also seeing the kind of jump in the volumes. So is it, a fair understanding that as we expand the capacity, there is enough firepower in the pipeline as far as demand is concerned, that, the growth shouldn't be a concern for, at least the next few years even on scale. So that be a right, way to think about the business now?
So, if I understand your question correctly, you are saying capacity-wise, are we building enough, right?
No,
what I'm trying to understand is the number of clientele has doubled over 2-3 years. And as we mine more wallet share from the clients, we are still small. As far as the big, pond is concerned. So I am trying to understand the scalability business over the next 3 to 4 years, whether the 20% growth is something which can be envisioned given our size and the opportunity.
Percentage growth-wise, we do not give any guidance, but we stay optimistic on all 3 verticals, Sudarshan.
Yeah. And also, Sudarshan-ji, in terms of whether there is a potential or not, and is there a ceiling in terms of, wallet share increase, then at least from that perspective, that is not there. Our size itself is, very small compared to the overall market opportunity and the amount of outsourcing business. So there is no fundamental limit that we are approaching there.
Sure. Thanks a lot, Ajay.
Thank you.
Thank you. The next question is from the line of Vilina Jain from Perpetuity Ventures. Please go ahead.
Hi. Could you highlight some key drivers for the CDMO business growth, and do we expect the current momentum to continue for the year and 2-3 years going forward?
As we have mentioned earlier, we don't want any vertical to be looked at on a quarter-to-quarter level, because quarter-to-quarter variations will always remain because of various internal as well as external factors. But we are very excited. We are looking positive momentum there, and it is not specific to this quarter. Now it is kind of becoming a habit for us and our investors to see. So we continue to stay positive. What kind of percentage we'll be able to maintain quarter-wise, it's difficult to say, but very, very optimistic. Yeah. And the reasons also stay the same. We have been consistently working on adding new customers, new product launches, trying to get more wallet share, building strong relationships, building internally strong business development and customer service teams. So all those factors we continue to work on.
Understood. Secondly, you have mentioned regarding an acquisition of a basket of market authorizations in Europe to expand your portfolio and geographical reach. Could you highlight the cost of acquisition for the same and what are the plans?
So we are not providing that level of detail, but our goal over here was to get access to already approved genericized products, and then expand the markets to our core markets and exports. And having a European MA allows you a quicker advantage both in price as well as registration in many other countries in ROW markets. So that is our first, to use these MAs to strengthen our core markets. And secondly, then as we are able to execute technology transfer and bring these products into our plant, which will take some time, we want to also explore opportunities in those markets where our plants are approved. So we have approval in Europe as well as we have now approval in South Africa. So we want to extend our export business. This has been something that it takes long time to build and incubate, and we were also very selective in trying to look at which products to acquire and so on and so forth. So this move is now something that should help in the long run for our exports to grow.
Okay. And the finance cost has increased for the quarter. Could you highlight the reason for the same and also help me with the net cash number for June?
There is no huge jump as such in the finance cost. The there are a periodical CC utilization. There is also capex going on. So, but this is in the normal range, we would say.
Yeah, there's no special change here.
Ad hoc,
Yeah.
one-timers.
And net cash number for June?
I'm sorry, we could not hear that again. Can you repeat?
What net cash?
Sorry to interrupt, Mrs. Jain. Could you come a bit close to your handset and ask your question?
You're not clearly audible.
Yeah, we can't hear anything.
Mrs. Jain, I request you to rejoin the queue for further questions. The next question is from the line of Neelam Punjabi from Perpetuity Ventures. Please go ahead. Sorry to interrupt. Could you come a bit close to the handset?
Yeah, it's better.
Could you speak?
So, is this better now?
No, ma'am. Could you come a bit close to the handset?
Yeah, I'm a bit close to the handset. So, is it audible now?
Yeah, there's still a lot of disturbance on the line, Neelam. So we can hardly make one or two words when you speak.
Let me join back the queue then.
This was very
This was clear.
Okay. Firstly, congratulations on some good set of numbers. My first question is on the injectable facility. So now that it is commissioned, are all the expenses related to it in the base now in the Q1 FY'25 numbers, or are we expecting any incremental expenses from yours?
So, in terms of OpEx, the primary two heads are, the utility costs for energy costs basically, and second is the manpower costs. We are working in stages in terms of, the early, as we ramp up capacity and the plant starts to run more and more shifts, there will be some changes. However, in injectables, also, when you try to maintain humidity, especially during the seasonal rainy months, there could be some changes. So that's why what we have always said, Neelam, is that let us look at injectables at the end of the year, so that we have had a period of actual performance over there in terms of being able to see where we stand on costs. But as such, we are not expecting lot of drastic changes.
Okay, understood. And on the same, so you mentioned that the revenues would start from mid of Q3. So could you indicate approximately how long will it take you to reach the initial phase asset turn of 1.2 times that you had alluded earlier?
See, asset turn of 1.2 times means peak utilization, right? So obviously that is something that everybody wants as soon as possible, right? As management, we want it. It's hard to predict, but what I can tell you is that whoever customer we are showing our injectable facility, there has been very, very good response. We've got very good traction also because the customers are appreciating the kind of facility that we have put, the kind of products that we are offering. So, that's why I'm saying that let's look at it after 1 year of actual performance rather than giving you some projected number and then coming back and talking about it.
Okay, that's understandable. And I wanted to know what is our working capital days as on June and what is our net cash number as on June?
Neelam, balance sheet related numbers, because balance sheet also has not been published and limited review also happens of the P&L. We would give those numbers by end of Q2, September.
Okay. And on the tax rate, so it was marginally higher for the quarter. What's the effective tax rate that we should assume for the full year?
Tax, there was a little bit of the budget impact, mutual funds or liquid investments that you had. There was change in capital gains. So accordingly, we have made changes in the deferred tax in investment. So that has already now been factored in for our existing investment. So more or less the similar tax rate you can consider.
Okay. And lastly, on the trade generics business, so the growth this quarter was a bit slower at 14%. So is there some slowdown in this business, or is this just a quarterly lumpiness phenomena and we are confident of continuing our historical growth momentum?
So on trade generics again, if you look at the last 8 quarters, we have had quite a bit of quarterly variability, right? We've had a quarter of almost 19%, 18% kind of growth, and we've had quarters where we've got 73% growth. So that's why again, in my opening remarks also, in Komal's remarks also, it's very important to look at, the trade generics vertical from a longer time span perspective. And we are very confident, the kind of momentum that we have, we are very excited and very, very confident. So without giving you a number, I want to tell you that there is
no huge change in how we look at it.
Yeah.
Understood. This is helpful. Thank you so much.
Thank you. The next question is from the line of Nirvana Laha from Badrinath Holdings. Please go ahead.
Hi, thank you so much for the opportunity. So first question is regarding this injectables facility. So if I look at peak revenue and the EBITDA margin sort of that you've indicated before, 90 crores at say around 18%, 20% EBITDA. If I compare it with your base business, the ROC seems much less attractive. Like the numbers that I'm getting is sub 15% or around 15%. Whereas your base business, if I remove the cash and investments that you're holding, it's much, much higher, so 25% plus. So this is sort of counterintuitive to me because injectables, one would have thought that it would be at least, as ROC accretive as the base business. So can you tell us something about why this is the case?
Yeah, sure. See, when we look at injectables, when we talk about 1.2 kind of an asset turn, that is typically with the kind of mix of CDMO, trade generics and exports that we currently have in our existing business. But as we have also mentioned before, our goal eventually is to use more of this plant and capacity for export business, wherein the margin profile changes quite significantly and improves much better. So, the idea is to use the initial years to register more and more dossiers in our export markets. And then in the later years, as those registrations get approvals, we'll be able to do much higher profitability business, through exports. So while there always will be a mix, export, trade generics and CDMO, initially CDMO will be the driver of utilization. And in the next 3-4 years, the exports becomes the driver, wherein the profitability and ROC will change very much to the better number.
Okay. So you hope that the facility over time will catch up to your base business ROC?
Yeah. And injectable should actually, if you look at, the other companies, they're purely on injectable basis, the ROC will be higher, than OSDs. So.
Sure. And in the last quarter, you had mentioned that you were looking at a small acquisition of a facility to help you in reaching the 1,000 crore number. So any further updates you can give on that?
We have identified, shortlisted a facility. However, we haven't reached at the documentation completion stage, so don't want to say anything beyond that.
Sure. Not asking for a guidance, just in terms of understanding if everything goes smoothly, what is the earliest timeline for commercialization? This is just to understand what timelines it takes typically.
We continue so as we had mentioned earlier, we want to by end of this year, so FY'25, we want to be ready with the additional facility for being able to deliver the growth if that's possible. So we continue to try to do that.
Yeah, we will be able to update you better by end of next quarter.
Okay, got it. And last question from my side. In your trade generics and institutional business, can you give us an indication of what percentage is institutional? And can you tell us a little bit more about the institutional part of that business? Like in terms of margins, how much is it lower than your distribution business? Or how lumpy is it and how you're seeing, government traction in that segment after the budget?
Yeah, sure. One is the breakup we are not providing just from a competitive information perspective, right? But what we are seeing is that, programs like Jan Aushadhi and programs like Ayushman Bharat, which provide insurance coverage to very, very large number of below poverty line, people. They are also covering the medicines which are going to be consumed by those patients who are covered by insurance. And this is where government is ramping up the procurement through various institutions, because if the patients try to buy at full price MRP, then again it becomes out of reach for them. So this. What we are seeing is that, you can see even in government's announcements where they have said that 8,000 Jan Aushadhi Kendras are going to be somewhere like 26,000 in the next 1.5 years, right? So there is a very big push. We see that in the overall, just as Jan Aushadhi being one representative of one institution in the government, right? We see that in overall, numbers of Jan Aushadhi itself. Which are publicly available. So we believe that this space of trying to address the large, unserved population in tier 3 rural areas, almost 5.5–6 lakh villages, is fundamentally only addressed through two means. One is through the government space, institutional, where they buy and dispense the medicines themselves. And second is through trade generics, where there are no medical reps trying to visit doctors, because fundamentally it's not possible. How can you have a sales force that covers 6.5 lakh villages? So these two verticals are there and they are mutually reinforcing to some extent. Whatever we sell in trade generics, we are able to bid for those kind of products in Jan Aushadhi and other government tenders to institutions. So they are mutually reinforcing in that sense. And in both cases, we end up, as a producer, increasing our reach and getting our products out. So, this is why there is a great interest in this space, not just from our side, but also other industry participants. And we continue to be bullish about it.
Sure. Any comment on the margins on the institutional side versus your distribution or versus your base OSD business margin?
See, the margins actually vary, in case of institutional, vary too much product to product. What we endeavor to, however, is as a basket, we want to maintain at least the material margin level between trade generics as a vertical and CDMO. So that is how we strive to, and we have been maintaining it like that.
Sure. Thanks. All the best. I'll come back in the queue.
Thank you.
Thank you. The next question is from the line of Windlas Desai from Turtle Capital. Please go ahead.
Hi. Good morning, everyone. Am I audible?
Yes.
Yeah. Hi. So my first question is, on the dosage forms. I think, we kind of started injectable as a new dosage form. But as a company, in next 3-4 years, how do you look at expanding the dosage form, for us, both organically and then inorganically?
Actually, we are very keen to look at expansion in dosage forms because for the simple reason that it serves all three of our verticals. We will be able to improve our breadth of portfolio for CDMO, trade generics, as well as institutional. So this is something that is a very important, growth, aspect for us and strategy for us. Now, injectables we decided to do on our own, primarily because the facilities available for sale in injectables were very old, and GMP considerations, quality considerations did not make it a prudent approach to buy something and then retrofit it and try to do it like that. So we built this one. And in terms of other dosage forms, there is a great opportunity, we believe, in other dosage forms like ointments, soft gels, hormones, steroids, eye drops. There are so many other protein powders. There are so many other dosage forms where we can do this play again and again. And we are looking at options both in terms of we have an open this thing. So our goal is to see wherever we don't need to do something on our own, and a good asset is available that is profitable and is meeting our criteria, then we would go ahead for that. So this is something that we want to do it. We are looking. There is nothing from my side to give you a concrete update as such.
Okay. The reason I'm asking this is that, some of the dosage forms are more difficult to enter into and kind of scale up, like steroids or hormones. So those kind of dosage forms, whatever that you want to acquire will come at a, generally these kind of things are not available cheap. You have to pay high, and so kind of do you weigh in vis-a-vis how difficult it is to create those capabilities, and if it is very difficult or time taking, you would be willing to pay a reasonable price and acquire for some of those difficult dosage forms? I mean, how are you guys thinking about it?
Yeah, absolutely. See, we are very conscious of making sure that if we acquire something, it has to be absolutely in line in terms of our ROC expectations, our ability to grow what we acquire, what is the spare capacity there, and so on and so forth. So the make versus buy, balance will always be there. Our criteria is that we want to, if we do find something, we have to do it in such a way that what we are paying for is justified by the opportunity it gives us in terms of expansion within and growth within what we acquire. So it's a self-justified way to look at something. So that's how we are thinking about it.
Yeah, we are not against paying any premium for. We understand that oral solids versus oral solids, their hormones facility would have a different premium. If there is a additional business addition also we are getting, there will be some more premium. So we are not against paying premium for a facility if it makes sense. Having said that, also, if how we look at it is, we want injectables now that new facility we have built in. If we reach a particular level where then that we start calling it our existing strong business, it becomes part of that. We are at that level, and by that time we do not get anything outside, then we can consider building something internally. If there is nothing available, it's not that we won't do anything for 5 years. It's not like that.
Okay, got it. Very useful. Second question is on the export side. I think, even in earlier interactions, we have always mentioned that the growth on the export side will be back-ended because of the registration requirement and the scale-up time that it takes. Now, if I understand correctly, we have been after this export thing for a couple of years or more. So I'm sure that the registration in various markets that we are interested in should be in place. So given that, do we expect much better growth, from this or next year onwards, the hockey stick scale up that we all were expecting on the export side? Are we nearer to that? And if so, any timeline that you can give?
Last year, if you see, we have delivered about 30% growth although it's a small base, but that is the kind of number that we delivered in FY'24. We continue to work on it, but in export segment, it is very easy after you reach a particular base number to expand from there. To reach there, there are several factors. I can assure you that we are working on all those factors. In past, however, what has happened is our expected timelines didn't hit, or something or the other kept on coming. So I don't want to, anyway, we are not giving a particular guidance against any segment, but we are working on all those things. We are at different stages for those different things. So we would expect in a medium term good numbers in exports. Yeah.
Okay. And any monetization? Sure, I'll come back in the queue.
Please come back in the queue. A reminder to all participants, in order to ensure the management is able to address questions from all the participants, please limit yourself to 2 questions. The next question is from the line of Pawan Kumar from Ratnatraya Capital. Please go ahead.
Hello. Hello.
Yes, sir, you're audible.
Yes. So my primary questions were like in the core CDMO business, we have seen in the past that the growth rates have been somewhere around 10-12%. But is there any reason for us now to believe that those particular growth rates can go up to around, let's say, 15-20%? Is that possible? Or that would be my first question. And my second question would be on the injectable side. Since our fixed asset terms we are talking about is only 1.2 times, my understanding would be like until we don't double this capacity, we won't be able to make a proper ROCE out of it. So what would be the timelines in which we can actually scale the current capacity and also think about actually doubling the capacity?
So let me answer your second question first. As we updated when we constructed the injectable facility, we have a spare floor over here which allows us to add capacity very, very quickly. So all the surrounding infrastructure for that is already there. But of course, any new initiative that you have to give it the required time for customer audits, approvals, stability data, and all of that to come through, and then add capacity. Otherwise, essentially you are just putting it with extra cost, right, with no immediate benefit. So we are very watchful of this, and rest assured we will be the first people to add capacity before its capacity becomes a concern. So we will not let it go in that manner. There is a inbuilt facility has the right design to cater and give us the best outcomes. In terms of your first question, which is around what is the prognosis in the CDMO. Sorry?
No, structural growth rates in CDMO, right?
Yeah. It's as I mentioned in my opening remarks, if you see the volume growth in Indian pharma market is very small, 0.7% year YOY. And so it's what is then driving the improvement in our numbers, or let us say the CDMO segments numbers. I believe there are combination of internal as well as external factors. So we have, of course, fine-tuned our own internal, business development teams and focused on executing to get, better wallet share as well as get new business from the customers that were added. So there is an execution element, and which is the most critical one, by the way. And then there is a second element which we have always talked about, even when we got listed, we talked about this, that the new Schedule M is putting focus on the quality of manufacturer who is making the products for the marketeer. Because now marketeer is equally responsible for defects in the product. They can no longer say that I did not manufacture it. They are equally responsible. And I believe that it is leading to change in thought process in a lot of companies who are saying that in order to comply, why not go to a better manufacturer who's got a professional setup, available capacity and strong track record of delivering. So I believe that the growth is a combination of both of these things. And hard to predict, but what gives me a lot of comfort is that we have shown a similar pattern over last 6 quarters, not just for 1 or 2. So, of course, we want to try to keep this up, right?
Okay. And I just missed the initial part of the call. So when is the commercialization of the new injectable facility expected to happen? Can we see something in Q2, Q3, or would it be later?
So, the injectable manufacturing requires that when you take commercial batches, which are the first batches of any product, you have to incubate them for stability testing for 3 or 6 months, depending on what the technology is and so forth. So all our batches which are being manufactured right now, they are all commercial and they are against orders, and they are all being incubated for stability. Our first we expect mid Q3 and really actually Q4 for revenue to come from sale of those batches which are already manufactured, and of course subsequent batches don't have that wait period anymore.
Okay, but does that mean, Hitesh, basically we are going to keep manufacturing, and at that point of time, when the stability whole period is over, we can sell whatever we have manufactured for the first 6 months in a bulk or something of that nature, or is that the wrong understanding?
Kumar, please rejoin the queue for more questions.
Yeah, I will just answer that. Yes, whatever after the first 3 batches data is completed, anything that we manufacture on the same product, we don't sell, but as soon as the first sale happens for that product, all batches that have been manufactured can be sold in lump.
Okay. Thank you.
Thank you. The next question is from the line of Rishi Kothari from PI Square Investments. Please go ahead.
Hello. Thank you so much for the opportunity and congratulations with set of numbers, and also giving on the updates on the injectable business. It was really helpful. My question is regarding one of the comments that you made in the future after as to we are looking more towards the brownfield expansion. So apart from the plant acquisition that we are recently looking by the end of the year, FY'25, any other brownfield expansion that we are looking at, in terms of the any diversification from the current product that we have?
No. So other than the facility that you also mentioned that we are going to acquire and the plant expansion that is going on within the plant, we do not see any major capex coming in unless there is some M&A that comes across. We don't see any major capex. Maintenance capex of 10 to 12 crores every year that we maintain. We don't also see any spike in there.
Okay. And the plant that you will acquire by end of the year, FY'25, that will be mainly for which product that we are targeting?
That would be for the similar oral solids capacity expansion. We are building that.
Okay.
Same dosage form, yeah.
Okay, sure. Thank you. I will join back with you.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity. Given the capex that we are doing for some debottlenecking in our...
Sorry to interrupt, Mr. Ankit. Could you come a bit close to the handset?
Sorry. Is it better now?
Yes, it is.
Yeah. So given the capex that we are doing, in which is expected to be completed in Q2 on the OSD side, how important does the acquisition of or the inorganic opportunity that we are seeking become in our overall growth plans for FY'26 and 27? If you can highlight about that. And secondly, on the acquisition, if you can throw more light on what are your criteria, what size are you looking to acquire, and if you can share some details on your criteria and like how important is the acquisition for our overall growth in FY'26 and 27.
See, the goal is to be ready to serve 1,000 CR revenue by end of this year from capacity perspective. And so both the things that we are doing, plant to expansion and the new facility that we want to acquire and make it ready for us is in that line only. So we want to be able to reach 1,000 CR revenue without any capacity constraint.
Sure. So given the run rate that we have currently of around, let's say, 175 crore per quarter, plus some additional revenues which will come from the expansion that we are doing. So, the new capacity or the new acquisition which comes in should have at least a revenue potential of around 200 to 250 crore is what we are seeking for.
Yes, from a capacity perspective, surely. And if more we can do, we will definitely do that. I would also like to address your other question in terms of what kind of M&A assets we are looking. We are not targeting a size, right? For us, the idea is to add to the breadth of our business, which can serve all three verticals. So the quality of the asset is the most important thing, and how much can we grow if we acquire that asset. So that is in terms of the business that can be increased in that asset. So those two are the most important criteria. We have not given any size limitation to our bankers, in terms of, okay, show us only below this or show us only above this.
So it will not be, let's say, an asset which is going through a tough time because of the new regulations which have come in. We want a quality asset where, they have established customers and established, quality standards, which are at par or with our standards. This is what we are looking at.
Yeah, very true, Ankit, because, it takes a tremendous amount of management bandwidth to turn something around, right? So, unless it's a complete slam dunk, that's not what we are looking for. We want to go with a quality asset that can be built on top.
Sure. And my second question is on...
Mr. Gupta, please rejoin the
Sure,
queue.
I'll do that.
Thank you. The next question question is from the line of Rohan Vora from Envision Capital. Please go ahead.
Hello. Thank you for the opportunity. Sir, I had two questions. One was on the API price environment and the outlook. Have the prices stabilized, and what are your views on that? The second question was, as I remember, we had introduced some of the injectable products, in our channel even before we could start production to just, be ready as our facilities become operational. How has the response been from those products? Was the second question. Thank you.
Yeah. In terms of your first question, what I can say in general as a sort of a, without any sort of numbers or this, but the general impression is that API prices are stable and in fact to some extent in some molecules, so common molecules, they are coming down. Okay. Our CDMO is a cost plus business, so obviously it is that that is there. In terms of our own channel introduction of injectable products in our TGX division, yes, we have done this, and the initial procurement was from outside. And in some products we are finding some good this thing. We are building the distribution network around this. So while I cannot give you numbers, but this is something that we are finding good momentum and good response, and we want to continue to build it in the long run also. Even after our the goal of this critical care division within our TGX is to find the distribution, build a distribution network to bring those products into the market, whether they are manufactured by us or from outside.
Got it. So, sir, just question linked to the first answer that you gave. So, if the API prices are still coming down, and we've reported 23% growth in our CDMO and 14% growth in our generic business. So does that mean that we've garnered a higher market share, or what has been the reason? Because ours is a cost plus model, so just wanted to understand what has contributed to the growth in a falling API environment.
No, see, the cost of API is incident. If you see when API prices went up drastically, then also we delivered growth, right? So, I don't think that we can directly link, changes in input material costs to, being it as a driver of growth or not.
No, in this case, I was referring to as a driver of degrowth, given that, prices are going down and still we've reported good numbers. So I just wanted to understand where the growth has come from.
Yeah. See, you are asking whether unit realization is lesser for us, and despite that we have delivered good growth.
Yes.
Marginally maybe. Marginally,
yeah. Unit realization is a little bit down, but that's for us not huge. Yeah.
Okay, understood. Thank you, sir.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
My questions have been answered. Yeah.
Thank you. Thank you very much, ladies and gentlemen. That was the last question for today. On behalf of Windlas Biotech Ltd, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Thank you.
Thank you very much.